and then we'll take a look at the market. But I have some thoughts on this. I just think it matters. All right, so I got on a little tangent this morning thinking about this zero DTE. First and foremost, I know I have been doing lots of interviews and podcasts and webinars, so I've got to upload those into Slack next few days and kind of get a little bit caught up. But I feel like I am post taking a week off and then crunch of absolute earnings. It's been madness, right? So now we're winding down and I can kind of now think what's next. I really think we're getting into a volatile situation, and I want to explain what that looks like and why I see that. But first, Craig did a really great synopsis of the zero DTE yesterday, and then I read off a quote, which was, let me just show it to you. Why am I getting two of these? Anyway, it doesn't matter. Hold on. Mike Wilson, right? Was that it? That's it right here. So no, JP Morgan yesterday had this bit to say. Okay, so let's do this first and foremost. Right here. Basically, JP Morgan's Kalanovic, and whether you agree or disagree with his market timing calls, he's just, again, re-upping a worry about this zero DTE, destination till empty, I call it, but it's days till expiration activity that's been going on. Yesterday, it was 1 trillion. So it's massive amounts of calls, buying, selling against very few puts. And more importantly, it is also indicative of the mania that's going on with gamma. So he says notional amount of volumes for ODTE options is about 1 trillion. That's notional value. And he warns of possible Volmageddon, as dealers may not be able to deal with these options as they do never get in the money, creating volatility suppression, which will trigger a 10% drop. Now, that's not just clickbait. That's just his analysis. I've seen other stuff on this, again, since October, and there is a fear as it relates to, I was looking for like what? Black swan of geopolitical. This is in the options market. It seemed a little bit unnatural to be having this unrelenting move higher with no seeming pause. Well, we have, intermittent overnight pauses, and then it just gets picked right back up. And a lot of folks are trying to associate, is this a macro narrative going on that, folks are really bullish again because, they're just pricing equities on Fed cuts. Well, now that's getting turned upside down. They get excited, market goes higher when they see CPI drop. Now it gets excited when we see a CPI beat and raise. It doesn't really matter that the numbers for both job, unemployment, and inflation is highly disputed, and the Fed reaction function is highly disputed, but it's still the total focus of creating this mantra of why is the market, doing what it's doing with this short covering rally, follow through, in a quant quake, follow through. You saw what happened yesterday, right? Stuff that is seemingly, garbage, UPST and the rest still pop up like daisies and get the short covering treatment. So right now, this is really the market not pricing a macro headwind at all, in my opinion. It's very much this option flow that is the tail on the flea on the tail of the dog. So it's not underlying buying, and it's not real money hedging. So let me explain what I mean by that. Spot Gamma did this quote. Let me just bring this over a little bit here. Did this, and thank you, Hunter, for sharing it with me. Comment, right, on the zero DTE driven Volmageddon 2.0, okay, which is a way of describing a liquidity cascade that would itself lead to about, JP Morgan's assessment, Kalanovic's assessment of 10% drop. When we had the Volmageddon back in 2018, it only resulted in a 5% downdraft. That was nothing, right? That was nothing. So in modern day, valuation, it's twice the impact. So they did write about this back in September, and I remember that. no, October, excuse me, because of a particular moment in time where there was a big, check this out, $25, $1 million worth of these calls that sparked a 5% market rally. And this is the newfound research chart that he's basically bringing up and referencing. And it's funny, I've actually read this paper. So it's very geeky. Oh my God, it's so geeky, but it has some really good stuff in it as well. So I decided I would retweet it with the paper. And in it, the authors, they talk about how it's a little bit of the story of the cobra, where in India, under British rule, they would reward those who brought in cobras were kind of like a problem. And so they had a bounty where if you brought in a dead cobra, you'd get a reward. So guess what happened? Given that the market is reflexive, they started breeding cobras so that they could get a reward. And then the British, government kind of caught on to this, and they stopped giving rewards for dead cobras. And all these bred extra cobras were then released. So they had a bigger problem than the original one. I actually think more of this as like waterboarding, torture, where the market is being fed this copious amount of liquidity. Literally, the market makers are just relying on this, the reflexivity of markets to digest massive amounts of liquidity. And in exchange, of course, bears are extracting the most pain, but it is a very dangerous practice, right? Some people die. Some people, this is not something, the market, it's not healthy. It's just not healthy. So then I was thinking about this morning. Oops, sorry. Instead of, where the heck is this? Hold on. I just lost my place here. I was thinking about this, and I really hope that this makes sense. So the zero DTE is all the rage. It's also all the worry from a quant quake perspective. Right now, it's in our favor. It could turn and form this reflexive nature of puts. We have actually too much liquidity. I'm not talking about economic. I'm talking about with this flow of nonstop buying in calls. Craig did a great job of kind of highlighting even Silvergate has 4 very, very large stakes in its ownership, which happen to be market makers, the citadels and such. So they have to take on this, this hedging nature to protect what's going on in the options market. And they are becoming the largest buyer, marginal buyer. And this is definitely not a theme that is sustainable. So we have a lot of plumbing that I don't even understand completely. I remember this article, Liquidity Cascade by Newfound Research, because that chart, I remembered the chart. I remember the Cobra effect, right? With the British rule and incentivizing the Indians to those in India bring in the cobras for reward, and then it bred even more cobras, and it just turned very nasty in the end. And we're still worried about this. And then I thought, okay, so when does this, well, for lack of a better word, this market structure that has now turned, and I can see that it's not just short covering, but there are actual real buyers coming in thinking that this is going to be a secular bull market. You have all the wirehouses and Tom Lee and the rest saying, we're going to 6,000. And maybe this, melt up can continue. I still don't see a solid reversal in net selling, although the breadth, divergence is scary. The yields in the dollar are, percolating again. That's scary, et cetera. Something can break. But when I look at this, I think, wait a minute, what about the real buyers? There's sentiment, which changes price action. There's this ODT market structure, which is clearly impacting the optionality of dealers and such hedging, and hedge funds themselves doing zero DTE. They don't have to put up collateral. It's not just retail. It's a combination of retail. It's a combination, probably only 20%. It's a hedge funds and dealers themselves. So I don't know how this is going to shake out. And I haven't, like I said, really dug into the mechanics of it, except for that one article on liquidity cascade, which is so very geeky, and left my head spinning. But the concept to me of paid to wait, it was those who don't trust the market because of this action, portfolios and those managing portfolios are definitely parking money and earning yield and T-bills and waiting until this kind of like finishes before it's more sensible, right? So the paid to wait theme for me anyway is not just folks who don't trust the rally, but they see a better return than stocks and bonds. And then I how I used to always follow big flow positioning. I loved to come up with trends and swings that looked fabulous on a chart. And then I would go and look for the option flow of size, which was basically positioning, not the weeklies, surely not the 0 DTE, but I would look for those who were really putting up a flag, right there. And they were very bullish, and you could see it in large flow of options further out in time, right? Leaps and the rest. It's few and far between. And that's also statistically proven because the short duration stuff is just taken off. When I start to see these institutions become bullish again, right now they're paid to wait. And a lot of finance committees will start talking about this. Hey, we can earn 5%. We don't have to take on the risk. When they do really become bullish, and I don't mean the CTAs that right now are in the 99th percentile because they're just technical levels of buying. And right now the risk is to the downside with CTAs, by the way. And Craig also highlighted that point. So that's important to know. The risk of this upside melt up is really reaching its nadir, I believe. And the CTAs, if this turns lower, have incentive to sell and $200 billion worth. So CTAs are their own thing. I'm talking about big institutions with real money that also put on real hedges, and we can see the flow, which right now is few and far between. Am I making any sense? So when these institutions become bullish again and they add equity exposure, and I'm talking about underlying stock, they need to hedge, not this 0 DTE crap. So further out in time, we'll start to see it. Is it then safe to go all in? No. And here's why. I was thinking about this morning. As real buyers start to pick up, so will volatility. And that volatility intermarket thing that I showed you a little while ago, which is basically we're in this period where we're not just going to have, a controlled drawdown like we did in 2022. Even though we went all the way down to 35%, negative in NASDAQ and 23% in SPY. And right now we're just sitting right in the middle between all-time highs and all-time low, last year's highs and lows. The point is that this year I see a lot bigger spikes in volatility. And I mentioned that. That's the one kind of, once my indicator flatlines is when we have bigger swaths of volatility. And last year it was pretty darn controlled. And that's when I'm actually thinking real buyers will not only show up, right, but they'll also trigger volatility. This is what I'm looking at right now. So instead of these kind of controlled destruction down drawdowns, I think we're going to get some downdrafts. And that's ironically going to make real money hedging matter even more again. So that's my, kind of like takeaway from this whole reminder that Spot Gamma has in there, which is liquidity cascade is a risk. And I, think a better title would be waterboarding, honestly, but that's my own 2 cents and I've shared it with you. Now let's take a look at the market. This is something that nobody is freaked out about. I think this roundabout on bonds, and I want to emphasize this, the only reason I have not issued a brace for impact, okay, if bulls don't defend here, is because net buying continues in the equities market. My crash alert, if I put one out, it's going to say brace for impact if bond bulls don't defend here, right? I've always said, brace for impact if equity bulls don't defend here. This rollover, taking this out, nobody sees it right now. Okay, this is already, it was incredibly tough to get above. Tried. You can see the weekly. Could not close above, but one little week and then it pulled back sharply, like kind of gold did. That was a worry. Anyway, this is what I'm looking for. We come back down. We come back down. We come back down. We're going down. So just remember, this is a 40-year. I can't even show you. This is the head and shoulders, right? This is the COVID crash up here, March. Anyway, the point is, this is still in a downtrend. Treasury selling represented by, we can't really tell, by Japan and China and the like, but we can tell that there is obviously more selling in bonds than buying, and yields are very strong. So I contend yields are going to wake the complacent bears from their slumber. The question is when. So do I have a higher yields thesis? Absolutely. Have I shown that technically? Right? We already have a macro backdrop, which we talked about at length yesterday. So we're talking, macro and fundamental. We got higher yields coming. Wages, sticky inflation, et cetera, et cetera. When the market starts to price it in is when bonds start to roll over hard. And right now, this is extremely dangerous. Market doesn't see it, know it, care. Never even made it, to have any. Look at the 200 right here, that 109. We had to get above, otherwise we're going to come back. I said 103.81. We took that out because of that rollover that I was looking at in ZB, and it's just not done. Very weak. So that's the alert that I'm most worried about. Bonds rolling over is absolutely going to put a kibosh in this rally.